So, you're doing business in Saudi Arabia or the GCC. You know that zakat is a core financial obligation, but let's be honest, figuring out exactly how to calculate it can be a real headache. Well, in the next few minutes, we're going to break down the entire process step by step so you can tackle it with confidence. Let's get right into it. Okay, so at its heart, what is zakat? It's a religious wealth tax. For companies, it's a flat 2.5% of their net worth. But here's the kicker, the really crucial detail. It only applies to the slice of the company owned by Saudi or GCC nationals. The part owned by foreigners, that's usually handled through corporate income tax instead. Simple enough, right? A 2.5% tax. But here is the million rial question. 2.5% of what? See, the real challenge isn't the percentage. It's figuring out the zakat base, that specific measure of a company's true zakatable wealth. And that is exactly what we're going to pin down. Here's our game plan. We'll quickly cover the two mandatory calculation methods. Then we'll walk through a hands-on case study with a company we're calling ZATCA. After that, we'll see how to choose the final base, and we'll wrap it all up with some common mistakes you'll definitely want to avoid. All right, let's dive into the core of the calculation. You see, to find a company's true wealth, the Saudi tax authorities know that just one formula might not give the whole picture, and that's exactly why they make you use two completely different methods. The first method is the adjusted net profit method. Think of this as the income statement approach. It's all about profitability. The second is the net working capital method, which comes at it from a totally different angle, focusing on the balance sheet, so assets and liabilities. The most important thing to remember is that you are required to calculate both. You don't get to pick your favorite. You know, the best way to think about this is like you're taking two different paths to find the same destination. Each path gives you a unique view of the terrain, and by comparing those two views, you arrive at a much more fair and complete picture of the business's real zakatable wealth. Theory is great and all, but let's make this real. We're going to apply these formulas to our fictional company, ZATCA, to see exactly how this whole thing works in the real world. For our first method, the adjusted net profit one, everything kicks off right here with ZATCA's profit before tax, or PBT. For them, that's 163 million Saudi riyals. That's our starting block. Now, we don't just take that number at face value. We have to adjust it to get closer to the real zakatable wealth. So you'll see we subtract income that's not from the core business, like a 58 million gain they got from selling some land. Then we add back 76 million in expenses that, for zakat purposes, don't actually reduce wealth, things like depreciation or maybe some fines. That gives us a final adjusted net profit of 181 million. Okay, let's file that number away for a moment. Okay, path one is complete. Now let's switch gears and head down the second path, the balance sheet approach. This method doesn't care about profit for the year. It's all about the company's big picture financial position, what it owns and what it owes. This method looks at where the money to run the business is coming from. We combine the company's long-term liabilities and its total equity with something called adjusted working capital, which is basically the company's short-term operational cash. For ZATCA, this all adds up to a raw base of 831 million. And whoa, as you can see, that is a very different number from our first calculation. And this brings us to the climax of the whole calculation. We have two very different results, so which one is right? This is where the absolutely crucial floor and ceiling rules come into play to give us our final answer. So let's just lay the problem out there. Our first method gave us 181 million. Our second one gave us a whopping 831 million. The gap is massive. So how in the world do we resolve this? Well, luckily, the decision follows this clear four-step process. We've already done steps 1 and 2. Now, for step 3, we just pick the higher of the two values. But the final and most important check is step 4, comparing that result to the company's total equity, which acts as a hard cap. This right here, this single rule, is the key to the whole process. Think of it this way. The adjusted net profit, that first calculation, that acts as the floor. The zakat base can't possibly be lower than that. But the company's total equity? That acts as the ceiling. It can absolutely not be higher. It's a really important safeguard to make sure the base is fair, but never exceeds the total funds that actually belong to the owners. So when we apply this to ZATCA, we first take the higher of our two numbers, which is the 831 million. But we immediately compare that to the ceiling, the total equity, which is only 408 million. And since the base can't break through the ceiling, our final zakat base gets locked in at that lower number, 408 million. We're almost there, but remember that first rule, Zakat only applies to the Saudi and GCC portion. So for Desert Tech, that's 60% of the company. The other 40% is going to be handled under corporate income tax. And now for the grand finale, we take our base of $408 million, apply the 60% Saudi ownership to it, and multiply that by the 2.5% Zakat rate. And there it is. The result is a total Zakat due of 6.12 million rials. And that's our final answer. Now that you understand the process, let's quickly run through some common pitfalls. Getting these wrong can lead to some pretty significant adjustments during an audit, so staying compliant is absolutely key. Okay, a really big one is shareholder loans. For a loan from a shareholder to actually be treated as debt, it has to pass 3 tests. There needs to be a written contract, it should be interest-bearing, and you need evidence of repayment. If it fails these tests, the tax authorities will just reclassify it as equity, which can raise your Zakat base ceiling. Let's hit 3 more crucial areas. First, provisions. You have to add back any provisions you've made for things like doubtful debts. You can only get a deduction when the debt is actually officially written off. Second, inventory. Remember to exclude raw materials from your Zakat base. And finally, the golden rule of all finance. Document everything. You have to be able to justify every single adjustment you make. From a practical standpoint, you've got to remember your deadline. You must file your Zakat return with ZATCA, that's the tax authority, within 120 days of your financial year end. And your work isn't over then. You should always keep detailed reconciliation worksheets ready, just in case of an audit. So the main takeaway here is this. A successful, compliant Zakat filing isn't about just one simple formula. It's built on really meticulous preparation, detailed documentation, and a deep understanding of both of these calculation pads and how they work together. So I'll leave you with this question. After seeing this entire breakdown, what is the one conversation your finance team needs to have right now to get ready for your next Zakat filing? Thanks for watching.